Welcome to the Possible Promise podcast, where we break down the complexities of finance and point the way to financial success. Today is August 4th, 2020, and I am your host, Brandon Oliveris.
And I'm his wife, Christine.
This is episode 14, How to Pick a Direction. Hey everyone, I'm sorry we are late today from what I announced. I don't know if anyone's listening or not, but we had some technical issues where every time I tried to start the podcast, my sound would cut out, and I wasn't sure if it was the microphone or the app or what it was, so I restarted my computer. Now we seem to be working.
Yay!
So that seems to be good. That was bad. It took a while to fix that, but
should have just restarted right away.
I haven't restarted for I don't know how, probably weeks. It's been a while, and issues have been cropping up, and I hate restarting my computer.
It doesn't take that long. You're just lazy.
Yeah, I know. It's just I don't like taking time to actually restart. But now we're good. So yeah, we took a little bit of a hiatus. I'm sorry about that. It was kind of unexpected. Just some stuff going on personally that it was hard to do the podcast. So now we're hoping to be here every. We're going to go back to the Monday-Friday schedule for now, I think, just to not be overwhelmed. And I know today's Tuesday, but we're going to pretend it's Monday. And so that's what's going on with that. So a couple announcements before we get into everything. Number one, I'm changing up how I'm doing things a little bit. So the new plan is to go live at 1 p.m. Eastern instead of noon. It just works better for my schedule, and still the middle of the market day, so it works. So we're going to go live at 1 p.m. Eastern, Monday and Friday, today notwithstanding. And other thing is that instead of the chat function, it's still there right now, but I'm planning on taking that down because I figure that if you do want to chat, whether you're listening live or whether you're listening later, just mention me on Twitter. The username is @PossiblePromise, all one word, no other characters or anything. Possible Promise, and if we get it during the show, I can acknowledge it if applicable, or if I need to. But yeah, just feel free to mention us on Twitter. And
that's a good idea.
Yeah, I
didn't know any of this. By the way,
no, I know. Well, you do the time change.
Well, okay, but
it just seems easier. I realized why pay for a whole separate chat service that we could just use Twitter.
I thought that was just part of it.
No, I mean, well, the Spreaker chat is, but you have to have a speaker account to use it. And I had a separate chat role on the actual live page.
I didn't know that.
Yeah, so there's no point doing that. Just mention us on Twitter.
Plus, it gives us more fame.
Sure.
Oh, well.
You should follow us on Twitter first, by the way.
Yeah.
We're still kind of trying to build up our Twitter following. One last announcement. On Friday, we are having, I'm doing, no, I don't want to call it an interview, but we're having
we're having a guest.
A guest on. I couldn't think of the word. Literally, I didn't want to.
It's called a guest.
I was going to say co-host. That wasn't really a guest.
I'm the co-host.
Yes, a co-host. We're having a guest on. We'll be recording it tomorrow, but we'll play the conversation on Friday. And
but we'll still go live, right?
We'll still go live on Friday. Yeah, I'll just play it. But so we're going to do that on Friday, and our topic is going to be basically, just basically the craziness of the market and how a lot of people think that it's like get rich quick. They can just jump in and make a whole bunch of money off of stocks, but what the reality actually is.
That's kind of what I thought at first.
Yeah.
Because you were doing so well
Right,
before
yeah,
all
it
this
seems
crazy-
really easy at first, and so
Yeah.
and the market is so.
You even thought so too.
I thought so too, but right now, the market is so insanely overextended that I think it screams bubble. Let's say that way.
I'm just surprised it hasn't been a lot worse, like 1929.
Well, I mean, maybe not that, but I definitely see parallels to maybe like the 2000, .com bubble. Maybe not as specific. It's not
I don't know anything about
focused in a particular area per se, but it's so overextended. I mean, we had, and I wrote this down beforehand, thank goodness. Last month, the S&P grew 5.5%, and the NASDAQ grew 7.4%. Today or I think yesterday, I'm not sure about today yet, we reached all-time highs in the NASDAQ. We're over 11,000 now in the NASDAQ. I mean, it's just crazy. And just entirely, I think it's a bubble. I mean, you can't fight the market. Like, I am bearish, but you can't really fight the trend because you'll get run over. But it's just so overextended. Like, something has to happen. There's just I don't see the reason. I mean, it's up today because of, they're sort of making some progress with the stimulus. But even if that's the case, I mean, we're still over 10% unemployment. The GDP last week came out at, what was the number? Let me find it. GDP negative 32.9% annualized. I think it was negative 9.5% for the quarter, for the second quarter of 2020. That's the biggest drop since I don't even know when, for a long time. And that's just, I don't know what the market sees that it keeps going up. I don't know. But anyway, we'll talk about that Friday. So I'm excited about our guest that we'll have on. And I'm not mentioning his name. I wasn't sure if I was going to because no one will
You could.
know of him. Okay, so his name
He's
is...
French?
Yeah.
He has a French accent.
Yes, he's really cool. Jean-Christophe. I hope I'm pronouncing your name right, by the way. Let me know on Friday. Jean-Christophe, he's in... he does options. He's a lot of how I got into options and got as good with them as I am. So I'm excited to have him on. It's pretty cool. So we will have him on Friday, and that will be fun. All right, so today we have... Let me just get a market overview. I'm doing a little bit different, just so you don't ask. All right, so today I'm looking at... Let's see, the Dow is up about 100. The S&P is up about 4 points, only about 13 basis points. The NASDAQ, again, over 11,000. I just can't believe that.
What was it before?
Almost unchanged, though. Only up 6 points. What's that?
I didn't know what it was before, because you said...
When? Before the
I don't
pandemic?
know.
It was below 10,000 before the pandemic, I think.
Okay, so now it's up.
It was... I remember it breaking through 9,000.
I just never have paid attention.
And that was a big deal. So the NASDAQ actually not up too much today. And the Russell is up about 8 points, about 0.5%. And the VIX is down a little bit, about 2.5%. So that's where we are market-wise today. And yesterday, we had a big rally. I think the S&P was up almost 1%, and NASDAQ was up, who knows how much, like 35, no, just kidding, percent. Up, 1,000 points every day. No, just kidding.
That's pretty bad.
So that's kind of where we are today, and it's kind of have to, work with what you have. So
yeah,
that's what's going on. Like I said, I think the news today is mostly with the stimulus, although nothing's decided yet. They don't even know if they're going to decide this week. So, but somehow that's still good news. I don't know.
It's hope.
Yeah, so I don't know.
Or maybe it's just hope.
It's this there's a thing they call when the market's just going up despite all this bad stuff happening. It's climbing the wall of worry. It's like, even though it should be worrying about all this stuff, it's just climbing higher and higher and higher. Eventually the bottom will drop out, but when that will happen, who knows? All right, so on that super positive note, let's get into our weekly stock picks. Let me see. Here it is. All right, so our weekly stock picks for this week. I am, as always, as I have been doing the options, I'm going to do the earnings one a little bit different as well, so we'll talk about that in a second. So
it's not really a weekly stock pick?
It's an options. It's still a stock.
That's true.
Hey, what? Would you like me to rename the segment?
Yes.
Well, too bad. Not today. So...
Because then people think it's just for stocks.
Okay, well, it's not just for stocks. It's for options. It may sometimes be for stocks. Anyway, so today my trade is on the Russell ETF IWM because I haven't had a position on that for a while. So I had a call credit spread on the Russell that worked out a few weeks ago, and then this is when it dropped down to around 139, 138 or so. I didn't want to trade on it again because it tends to be rather volatile, and now it's back up around 150. So I figure this is a good time. But instead of, and this is going to be kind of part of our topic today, actually, so I will mention some of this now and then explain it later. But instead of trying to pick a direction, because I have no idea where the Russell's going to go, I've one of my first trades on IWM was a call credit spread, and it got wiped out so badly it was insane. So I get a little nervous with picking a direction with a Russell because it can be up or down any number of points pretty quickly. Mm-hmm. Let me see if I was filled though. I had a not filled yet.
Darn.
I'm gonna see where it's standing. Okay, it'll get there. I'm gonna mark it down 1 point. Okay. So IWM, instead of picking a direction, I'm doing what's called an iron condor. I'm going to explain iron condors later today.
Oh no. No, just kidding.
It won't be that hard.
I know it's not.
I sort of covered them a little bit before, but I'm going to discuss them at greater length today. So what I'm doing in IWM is a short put, basically a put credit spread from 133 to 131, combined with a call credit spread from 172 to 174.
It's like you're covering the gamut.
Yeah, you're covering both ends.
Yeah.
And it's at 150. So anything, basically how this works, and this is for the September 18th expiration. So basically how this works is as long as it remains above 133 and below 172 by September 18th, I will be okay.
Yes.
Okay, so that's basically how it works. So again, it's a put credit spread, so the short put 133, long put 131, and then a call credit spread with a short call at 172 and a long call at 174. And so that gives us a nice, what's that, like, basically is 18 point wide on either side.
Yeah.
Altogether it's like, let's see, 133 to 172 is like how many points is that? 40, almost 40 points. Yeah.
Yeah.
So, you have a good 40 point range that I can trade within by September 18th.
That's crazy.
And that's why I'm doing that. And it's pretty volatile, which is why I'm able to do that. So that's the options pick I am doing for this week. By the way, my SPY that I did about, a month ago or so that I mentioned has gotten entirely wiped out. It was a call credit spread at 317, and I think so. And today SPY is at like 329.
How did your last one do that? What did you do last time?
Which one?
For the last...
AMC, was it?
I don't know.
Yeah. I did one on SPY, which is flopping. I did one on XLU, which is flopping.
I remember that one.
Because of the market just incessantly going up. That has a couple more weeks, but I'm not super optimistic about
You
it.
never know. You've had crazy stuff happen.
Yes, that is true. And then I have an AMC put credit spread that I mentioned. I think was my last one.
Ooh, AMC, the movie place?
Yeah, you said the same thing last time.
On the podcast?
Yes, you did.
Oh.
That
Goes to show how long it's been.
Put credit spread between $2 and $3, and today AMC is at like 416 ish. So my AMC is just at the point of closing out a 50% profit. It's so close.
I'm surprised because it's not like you can go to the movies.
Yeah, I don't know. I don't know how they're doing well.
Unless it's the app doing it.
I honestly have no idea.
Because you can watch from home on AMC apps now.
I have no idea.
Like, so you don't have to go.
Yeah. So, but AMC's doing very well. And so those are some of the previous ones. SPY got wiped out, just absolutely. So I'm holding on to it because it's only, I have nothing else to lose in there, so.
And you never know.
Yeah. And like I said, the IWM, right now, it's still not filled, but I'm trying around 31 cents. I'm going to hold that for a while. So around 31 cents, 30 cents is kind of, it's not the greatest price ever. I'd like more, but that's what I'm getting. And then earnings for this week. There are lots of earnings trades for this week. Apple was last week. Pretty much all the big name stocks were last week. And
they probably
I got obliterated in Facebook. Did I tell you about it? Yeah, I told you about it. I had a very wide iron condor on Facebook, and it jumped 7% overnight. I got, luckily, I was able to salvage a little bit where I didn't lose as much as I would have if I held on, but I still lost, I think, I don't know, a good 30 cents or so. I don't remember.
You lost 30 cents.
30 cents times 100 shares, so $30.
Oh, well, still.
But, Facebook, yeah, that got wiped out. So this week, tonight I'm looking at either Disney or Beyond Meat.
What's that one?
Beyond Meat, I told you about that. I remember that's the one you were thinking about trying. Beyond Meat, that's the vegetarian.
Oh, Beyond Meat.
Beyond
Meat,
yeah.
Yeah.
That's probably what I'm going to do tonight. But for those who may not get this until like tomorrow, my actual earnings trade I'm looking at is Square.
The credit card app.
Yes, SQ. And so let's see for Square. Now I haven't done this yet because I won't do it till tomorrow. So I will show you how to do an iron condor trade. But right now, Square is at let's see, 135.81. So if for earnings, what you'll want to do if you're doing, you can either buy the stock, or what I'm going to do is do an iron condor in there. And you would do it for this Friday's expiration. So this Friday is the 7th. And right now, as it stands, the iron condor, the short side, or the call side would be on, let me see. That doesn't sound right. Oh, yeah, it is. Okay, 144 for the call side and 128 for the put side.
I was going to say, it doesn't lie.
No, I know. I thought I had checked it earlier and I thought it was higher, but it wasn't.
Oh.
So, we'll see what I do. I don't do the actual trade until the day of earnings, like before the earnings come out.
That makes sense.
Because that's usually when the big move is. And so that's what I'm doing for earnings this week. All right, so just to summarize, we're doing IWM, Iron Condor 133, 131, and 172, 174 for September 18th. And then I'm doing Square, whatever that turns out to be for tomorrow, which I'll teach you how to do and how to create that kind of trade here in a few minutes. So we'll get there. All right, so that is those are our picks for this week. And now we will get into our main topic. How to pick a direction. All right, so this one, I actually changed I have another topic prepared for another podcast, but I changed it because I'm sorry. I thought this would work better for this Friday. Like, I thought this would work better coming up to this Friday's topic, because I have, some things that I want to discuss before we talk about that stuff.
Yeah.
So, investing, well, traditional investing is all about direction, right? You buy a stock hoping that it will go up. And if it goes up, you're happy and you sell it at a profit. And that's what you get. Or if you think a stock's going to go down, you short it, you sell short, and then you buy it back when it goes down, and you keep the profit, and that's the same thing. So in traditional investing, people are always trying to figure out what's the next big stock that's about to go up really big or about to drop really big, so you can, buy a long position or sell a short position in that stock. And so if you were able to tell, like, how do I know whether a stock's going to go up, whether it's going to go down, that's obviously really useful, right? And there are, it's something I've focused on for a long time. There are sort of indicators. I mean, people have spent decades trying to figure out, obviously, how do you know if a stock's going to go up or down in the short term, in the long term. In the long term, most good stocks go up, right? Obviously, there are cases, companies go into bankruptcy, companies go out of business, so, stocks may disappear altogether. But something like Apple, Microsoft, Amazon, that's generally going to gain value over time and so go up. But if you're a short-term trader, then, you're more focused on what's going to do now. Maybe today, maybe this week, maybe this month, maybe even the next couple months, but what's it going to do in the short term, right? And that's a lot harder. And there are things you can look at. There's, I think I've talked about RSI before, where you can see kind of, is it overbought? Is it oversold? Is it having more up days than down days, or more down days than up days? And RSI is certainly a useful indicator. There are other technical indicators, price action in general, candlesticks, MACD, there's moving averages, all sorts of different indicators you can look at. Bollinger Bands. I mean, there's tons of different things you can look at. How useful are they actually? Who knows? I mean, I trust in some of them, but it's never 100%. You have chart patterns people look at, which I can't do because I'm blind. Trends, resistance and support. And you also have, analysts. So if if a lot of analysts are bullish on a stock, then you might think it's more likely to go up in the short term, right? Or if you think the stock's going to have earnings next week, which, we've done this on this podcast. If the stock's going to have earnings next week and you think the earnings are going to go well, then you might buy the stock prior to the earnings, and hope that it profits. Or if you think it's going to go poorly, you might short the stock before the earnings and hope that it drops. So, I mean, there's all sorts of things you can do, and some of them may work. Some of them may not work. I think that a lot of times what it is a bit of intuition. I believe when you're trading stocks, especially stocks that you're concerned about direction, the biggest thing you can do, the best thing you can do for your portfolio is to be familiar with that stock. Mm-hmm. You don't just see someone's random recommendation on Facebook and say, oh, I'm going to buy this. And then, it drops and you wonder what happened, right? You're not just going to find random stock recommendations on random websites or something and say, oh yeah, that's great. And then without any further research or due diligence, you just buy it, right? That's not generally going to work. So usually, you're going to do your own research. You're going to follow the stock maybe over a few days, a few weeks, or look at its, recent history, look at its price action. What has it been doing? And that will give you a good idea of how it tends to move. Mm-hmm. For one stock, a $1 move is common. You might see that every day, while for another stock, it might only move a few cents a day. Right? It just depends. And so you can see that, and you can see the trends, you can see the patterns. That's no guarantee that a stock's actually going to do what you think it's going to do. But, if a stock is trading near its 52-week high, for example, and you don't see any good reason why it should be, or, maybe this is a good resistance point where it's rarely gone above this point before, then that might be a point where you go short. Or if it's trading rather low and you don't see any good reason why it should be, and you think there's a good reason why it might be going up in the future, or this is just the lower part of its overall range, maybe over the last few weeks, few months, then you might go long. You might buy the stock. Those are all things you have to figure out, and it takes research.
And even with that, sometimes you just don't know.
Right. I mean, almost always you just don't know. The other thing you can do, I have a subscription to Zacks, and I love their portfolios, and I love their service. And I'm subscribed to several portfolios there. And some of their portfolios I don't really trust as much. I've, tried them, and they've kind of flopped. But there are a handful of portfolios of analysts there that I trust their recommendations. Mm-hmm. So there are two people there in particular that, when they give a stock recommendation, and they'll give their reasons behind it, I'm probably going to trust it. Does that mean all of their picks work out? No. But more often than not they do, where maybe 7 or 8 out of 10 are big winners. I've had a stock from there before go up like 20%. Maybe one is a big loser. Maybe another one is a minor loser. But overall it's winning.
Right.
Right? No one's picks are always correct. It never happens.
It can.
And, for me that was a big obstacle as a trader, or even, as someone publicly recommending stocks. Oh, oops, that was a flop. That SPY call credit spread, that was a huge flop. How should I know the SPY was going to go up over 5% in the last month? It's probably higher now. But in July, I really didn't think it was going to be able to keep doing that. It was going to have the momentum to keep doing that. But
and a lot of times it wouldn't.
Right, exactly. So you have to be willing to admit when you're wrong. And, that's one thing I've had to get over. Like, oh my gosh, I'm going to look stupid because I gave this recommendation that's totally wrong now. But you can't do that. It doesn't work. Right? So no investor is right 100% of the time. Warren Buffett's not even right 100% of the time. Look at how we did on airlines. That's a really good example. And sometimes it looks like these retail investors who just are jumping in and out for no good reason on, hyped up stocks. Sometimes it looks like they're the ones that are right more often than not, but in the long run, they're not. In the long run, they lose. It can be hard to see that though, but it's no one's right 100% of the time. So, first thing is the trick is to be right more often than you're wrong. Okay. And you can do that just through looking at trends, looking at, what's been going on in the market, and looking at earnings, and looking at analyst reports, and that kind of thing. Or following someone you trust where most of their picks are good, And that really works if you are doing stock investing. Now, if you're doing options, that's another story. If you're doing long options like debit spreads or long calls or long puts, where you're buying the options, then that's a little more volatile. That's a little trickier. But same thing there. There are people who can really pick good options, good long options.
You sell them, right?
I sell them most of the time, yeah. So, but if you're going to go long on an option, you really have to make sure there's a good reason for that stock to go in the direction you think it's going to go, right? Maybe you're just jumping on the momentum, the trend, and so you think it's going to continue, and that's fine. But you have to do the research to know, I think this is going to keep going this direction, or I think it's going to go that direction, whether it's up or down, because of this. And either that opinion should either come from someone you really, really trust, like a portfolio service, or like someone, just maybe you trust personally, to be right most of the time, or preferably from your own research, right? So again, that's, something you have to get into, how to do that research, or looking at the indicators, or looking at RSI, or looking at, chart patterns, or whatever it might be for you that, you might look at fundamentals, you might look at momentum, you might look at earnings, you might look at analysts, you might look at indicators. There's all sorts of ways of creating an assumption on a stock. Mm-hmm. Now, the point I want to focus on is, what if you can't tell? Right? I don't know what my dog's barking at. I'm sorry about that. What if you just don't know whether a stock's going to go up or down? Right? That can definitely happen, obviously. And a lot of times you just don't know. Like with earnings. Earnings are a good example, because sometimes a company can have perfectly good earnings and they'll still drop. And sometimes they can have horrible earnings and they'll still go up for some reason. Maybe the expectations are really low, or who knows what. So sometimes you don't want to pick a direction. And that's why I want to introduce the idea of the iron condor. So this is actually, let me see what we're doing on time here. This is actually kind of two strategies in one. Okay? So the first strategy is the iron condor, which we'll discuss. And the second strategy, which is a little more complicated, or requires a little more capital, is the short strangle. Okay, a short strangle and iron condor are extremely similar, and I'll discuss them. First is the short strangle. So if you don't know whether a stock's going to go up or down, then you might sell options on both sides, essentially. So let's take that IWM example that I mentioned earlier. If you don't know, if IWM is around 150, and you don't know whether it's going to go up or down, you sell options on both sides. You might sell a call on the upside and a put on the downside. So maybe, if it's at 150, you sell a call at 172 and you sell a put at 133, right? Why those numbers, I'll tell you in a minute. But that way you have both sides covered, right? And if it stays in the middle of those two, then you win. So it's kind of a neutral strategy where, you don't know if it's going to go up or down. So whatever it does, you're probably going to be covered, because chances are, even if it goes up, it probably won't go up, $22. Let's hope not, by September 18th. Or even if it goes down, it probably won't drop below 133. And so you're covered on both sides. The reason you do both and not just, you could just do one, but you're not going to get as good of a price if you're that far out of the money. A $22 difference is pretty big on the upside. And so, that you're not going to get as good of a price for that. If you are just doing one side, just maybe a short call or a short put, you have to go closer to the money to make it worthwhile. So
that's why you cover both sides.
That's why you cover both sides. When you cover both sides, you can afford to have a wider range, right? If I wanted to say I think IWM is going to go down, then I might say, okay, well, I will sell maybe the 160 call, and that will give me a really good credit, right? I might look at something around like the 30 delta. Remember we talked about delta? That's one of the options Greeks, and it
you didn't talk too much. You were going to do another post.
I did talk a bit about it though, and I said, remember how I said strike selection, like you're going to look at around a 30 delta or like a 70% probability of profit.
That's right.
Yeah. So a 30 delta is usually what we look at for credit spreads, right? Or for just regular short options. So I don't know what actually the 30 delta is on that. Let me just see if I can check. But anyway, let me see if I can get to it while I'm talking. But, if IWM is at 150 right now and you think it's going to go down, you might sell the short side, or the upper side, the call, right? Let me see what IWM would be. Hang on. I'm guessing around 160, but I could be extremely wrong. Let me see.
Trying to find the delta?
Yeah, I'm almost correct. Alright, so let's see. I think it's about 158. Let me try one more. Yep. So delta...
Why does it say 0.3 something?
Because delta is a decimal.
Oh, I see.
I just simplify by saying the actual number.
Oh, okay.
So the 30 delta for IWM on September 18th is... 30 delta is 158, where the Russell, or the IWM right now is at 150, right? And the price on that is like $2.58. So if I were just to assume a direction, if I think IWM is going to go down, then I might say, okay, well, I will sell the 158 call, right? I will sell the 158 call. But that doesn't give me nearly as much room. I mean, I still have $8. That's still a good amount of room. I mean, maybe, 5% or whatever that might be. But, what if it has a rally? I mean, I don't know what's going to happen between now and September 18th. I'm not confident enough in saying it's going to definitely go down or stay neutral to be able to sell a 158 call. Right?
Right.
I'm not nearly confident enough. But if I say, well, I think it'll stay neutral, I think it'll range in this very wide area, this expected move between 133 and 172, then I can sell a put on the low side and sell a call on the upside at around a 16 delta. That gives you about a 1 standard deviation move. And then it can kind of go wherever it's going to go. And unless it really, really goes outside... Remember we talked about the equation for the 1 standard deviation move, expected move. 68% of the time, it's going to stay in that range. And the 16 delta... so the 16 delta for the call side is 172. The 16 delta... Actually, negative 16. For the put side is 133. And...
Where did you get 16 from? I got lost.
So I'm doing a 30 delta.
Yeah.
So our goal is basically to capture a 1 standard deviation move, right? To have at least...
I don't even remember you talking about that.
I remember the equation for expected move, and it gives you the upper range and the lower range. It was like expected volatility, or implied volatility times square root of...
Oh, that's probably when I tuned out. Sorry.
Anyway,
I think I vaguely remember.
So we're always trying to get about a 70% probability of profit.
Yeah.
So one way of doing that is by selling a credit spread on either the call side or the put side, right? So if I think it's going to go down, I'll sell a call credit spread with the short strike at about a 30 delta. Okay. If I think it's going to go up, I'll sell a put credit spread with the short put at about a 30 delta.
Okay.
Right? So in this example, you might sell a 158 and you might buy a 160, for example. So you might have a $2 wide call credit spread, 158, 160. Mm-hmm. That gives you a 70% probability of profit because it's a 30 delta. Right? So 30 delta means approximately 30% chance of being in the money.
Yeah.
Which you don't want it to be. So 70% chance of being out of the money at expiration.
Oh, okay.
Right? So on the put side, you might have... Let me see. Let's guess here. Ha! I got it first try. On the put side, it's a 142. Right, so 142 would be the 30 delta for September 18th. So you might sell a 142 put. You might buy a 140 call. Buy a 140 put. I'm sorry. And
put call.
I know that was an And as long as it stayed above 142, you'd be okay. And you'd have a 70% chance of that happening.
Okay.
But if you're going to do both sides...
Which you do for iron condors.
Right, you have to make it wider, because if you did 30% on both sides, that adds up. Now you only have 30 plus 30 is 60.
Yeah.
You only have a 40% chance of being profitable, because, 100 minus 60. So if both sides are 30% in the money, chance of being in the money, and you add those together, that's a 60% chance of ending up in the money.
Yeah.
Which you don't want. That only gives you a 40% probability of profit.
When you want 70.
When you want 70. So what do? You do either a 15 or a 16 delta. The reason I say 16 delta is that adds up to a 68% chance of probability of profit, which is one standard deviation is a 68% chance.
Right.
Just by definition.
Okay, you would know. I don't.
Yeah, well, it's just the definition of one standard deviation.
Yeah.
So you would do a 16 delta on both sides, so a 172 and a 133 in this example, and that gives you a far wider range where I don't know if it's going to go up, I don't know if it's going to go down, so I will capture both sides, and that lets me kind of, no matter what it does, as long as it stays within its expected move, right, which 68% of the time it will, then I'm protected.
So this is the strangle or the condor?
This is the strangle, because we're just selling short options. We're selling a short call at 172 and a short put at 133.
Okay.
And so, that gives us a much wider range there.
That's not even an iron condor.
That's a short strangle. So
okay.
the downside of a short strangle is, well, first of all, before we get to that, so if you were to do that, let's say, the 172 call for that is like, let me see here. No, that's not what I wanted. Here it is. No, here it's not. There we go. So the price you would get, the credit you would get for the 172 call right now is 22 cents, and the 133 put would give you 160. So that would be, $1.82 or $182. So if you sold that short strangle, you would receive $182 of credit.
Okay.
Right, which is really good, right?
Okay.
And so as long as it stays, the longer it goes, that it stays within that range as you approach the September 18th, that you would get that, more and more of that credit. Okay?
Right.
So the downside, though, is that it requires a lot of capital to trade that kind of thing. It requires a lot of margin. Right, because there's technically unlimited risk. Because let's say the Russell goes up like way, 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 way up. Let's say it actually goes up to like 180 by September 18th, right? And your short call's at 172. Well, now you're in trouble because now it's outside of your range.
Yep.
Now you're $800, in the money, right? And that's, you're in trouble. So your broker wants to make sure, like, hey, if something goes way wrong, you're going to be able to cover it. So usually short strangles require a couple thousand in margin to cover. Is that
when the assignment thing happens?
Well, you could get assigned, but this is just even without assignment, where if it goes way over your short strikes, then you have to have the capital to be able to manage that.
Yeah.
So they'll set aside generally, $1,000 to $2,000 or $3,000 to say if something goes way wrong with this trade, you'll have enough money to cover it.
Right.
If you don't have that kind of money, or you don't want to risk that kind of capital, then you define your risk. This is what's called an undefined risk strategy. It's a short strangle.
Okay.
Right? And it's the same thing on the other side. It could drop down to like 125, 120. I mean, who knows? And your short puts at 133. every dollar, remember, every dollar outside of your range is $100 you lose.
Yeah.
Right? So if it drops down $8,
you're screwed.
You're $800 out.
Yeah.
If it drops down $10, you're $1,000 out.
Ugh.
So if you want to define your risk, all you do is you buy what are called the wings.
For the iron condor.
The wings for the iron condor. Exactly. See,
I'm getting it.
Yeah.
You should have asked Christine and I would have gotten it.
Oh, darn. Okay. So
I just want to get A's.
Yeah. So basically, if you want to limit your risk, if you want to define your risk, and you want to say, you know what, I don't want to risk thousands of dollars just for this trade, I'm willing to risk maybe a couple hundred, right? Then you want to buy the wings. And that just means that...
So the short strangle is just the body of it.
Yeah, pretty much.
Okay.
Yeah.
Interesting.
That's a good way of seeing it.
Go
No,
ahead.
it's fine. So you want to buy the wings. So what you would do is you buy a call above your short call and buy a put below your short put. And they should be the same distance from the short strike. So you wouldn't... Basically, you might do like...
so it was at 170.
172.
So you'd probably do what?
Like, it depends how much you want to risk. You might do 173, 174, 175. I mean, if you want to risk a lot, you could do 180. It just depends.
Yeah. And
right?
then you do a little bit below.
The farther apart, or the larger the wings, the more you risk, but also the more credit you receive.
Right.
Right? Whereas the smaller the wings, the narrower the wings, the less the risk, but also the less credit. Right? So what I did with our pick was a $2 wide, wing on each side. Like I said, both wings generally should be equal. There are times where it's called broken wing butterflies, or usually I don't think it's done with iron condors, but it could be. Butterflies are another strategy that's similar to iron condors. We'll talk about that another day. But, usually the wings are equal size, right? And so you might have a $2 wide wing, or however much, and your risk then is the width of the wing minus your credit, your overall credit. So in this case, I did a $2 wide wing.
So that'd be $2 minus.
So actually, let's do this. We're going to make this and ask Christine.
Yeah, but I can't do math.
It's all right. So it's a $2 wide wing, and the credit...
Well, you didn't do the side... Oh.
I'm about to. I'm asking the question first. The credit, let's just say, is 30 cents. That should be easy. So what's our risk? If it's a $2 wide wing on each side, and your total credit is 30 cents, what is your total risk?
32? No.
200. I'm sorry, $2, 30 cents, and $2 wide wing.
I don't know.
All right. So you basically subtract them. So $2 minus 30 cents credit
is negative.
$1.70.
Oh.
$2 minus 30 cents.
Oh, 30 cents.
Yeah,
oh,
I knew you were missing that. Is $1.70. So because you can't lose more than the $2 that you risked, right?
Yeah.
So a $2 wide wing and a 30 cents credit means you can't lose more than $1.70, which turns out to be $170 because 100 shares. And so the most you can lose on that trade is $170, which is a lot better than like $1,000.
Yes.
Right, so...
Well, I epically failed that.
Oh, it's okay.
I told you I can't do math.
You get the basic idea, though.
I do.
So anyway, so if you want to limit your risk, you buy the wings, and that means that, let's say IWM goes to 180, it doesn't matter. You can't lose more than the $1.70 that you risked.
Well, you didn't stretch them to 180.
Exactly. You stretch it to 174. So anything over 174, it doesn't matter, right? Because you can't lose more than that $2. And
I thought it did matter because it's still outside the range.
Yeah, but that's why you bought the 174 call, because anything over that it doesn't matter.
Oh,
you can't lose anything more than the difference between 174 and 172.
Oh, okay, I get it.
Right? Minus your credit. So you can't lose more than that $1.70 times 100 shares.
Oh.
doesn't matter if it's 180, 190, 200. It doesn't matter where it is. You can't. That's why it's defined risk. No matter what it does, the most you can possibly lose is $1.70.
Okay, because you put a limit on.
Right, exactly. Okay. And that's the power of iron condors, where you get to use a very powerful strategy, but you get to limit your risk. So
God, that makes your head spin.
So to summarize,
because I was thinking without the wings.
Right, exactly. Without the wings, then if you're at 180, you're going to lose basically $8 minus whatever credit. It'd probably end up being about $6. When you count in the credit. $600, yeah. But with the wings,
because that's like extra protection.
It's exactly.
It is exactly extra protection.
It's exactly protection. Yes, it's exactly what it is. So that's the power of iron condor. So a short strangle is when you just sell two naked options. Where naked just means they're just the short strike. You don't have any leverage. You don't own the shares. You don't have enough money to buy 100 shares of it. But you're selling two naked options, a naked call and a naked put, at a 16 delta on both sides, and you get the credit and you get to keep it if it stays between those strikes. If you want to limit your risk, then you buy the wings and turn it into an iron condor, and you get to decide how big those wings are. You could do $1, $2, $3, whatever, and that limits your risk to the width of the wing minus your total credit, right? And that's basically how it works.
That's
so
easy.
It's powerful. Yeah, it's not too hard, and it's extremely powerful.
What?
Sorry, I was trying to find our outro music. And so it's a really powerful technique. So iron condors, it's a really nice neutral strategy. You don't know whether it's going to go up or whether it's going to go down, and it's okay because you're capturing both sides, and you're capturing basically a one standard deviation move of the stock, where as long as it stays within that range, which it will 68% of the time, you're good.
That's
right?
so cool.
Yeah, it's awesome.
I understand them better now.
Good. See, and
if you can teach me, not that I could do it in practice, but I understand the theory.
And it's great because you don't need to do all the, not to say you shouldn't do research, but it doesn't matter. So what we say is you're product indifferent. Like, you could trade any stock, and if you sell a short strangle or an iron condor on it, it really doesn't matter what's coming up, what news might be happening. I mean, it does a little bit, but overall, like, you could pretty much trade anything.
Because you're pretty covered.
And you're covered, right? Because the stock is generally going to stay within that range. Whereas if you're trying to have a directional assumption, whether you're trying to buy or sell stocks or do debit spreads or options, you have to kind of have an assumption, an informed assumption, but still an assumption that you could very well be wrong on, and it's harder to do that. It's much harder to do that. So I love iron condors and short strangles because it lets you kind of trade anything without really having an opinion, right? Now, if you do have an opinion, then great. You can do, a call credit spread or a put credit spread or, a 30 delta, like I mentioned. But if you don't have an opinion, just sell a short strangle or an iron condor. And it doesn't matter what you're really trading in there, as long as the markets are good, as long as you can get a good price for it. It doesn't really matter too much, right? So that's the basics of iron condors and short strangles. I mean, there's always more to discuss there, but I think that's good for today. And hopefully that helps. Like I said, it's great, if you really just don't know, if you really just don't have an opinion, which a lot of times we just don't. And so it makes it a lot easier. It cuts down on research. And what will happen is you'll kind of have a core list of ticker symbols that you trade on. You might have like sector ETFs, like XLF for finance, XLU for utilities, XRT for retail, retail, sorry. SPY for S&P, IWM for Russell, QQQ for NASDAQ. I mean, you just have kind of a core list of tickers that you jump in and out of, and kind of just trading neutral, or if you want to take a directional assumption, you can do that. And the great thing with short strangles, if you really do have an assumption where you say, you know what, I have a little bit of a bearish assumption, so maybe you sell a lower call spread or a lower call strike, and you move down your put because you want more room to the downside. Like for the Russell, if you think it's more likely to go down than to go up, you might sell, let's say, the 165 and maybe the 125 or something. You know what I mean? Like you have room to kind of still have a little bit of an assumption, or you can go totally neutral. So it's just a really powerful strategy. And you'll have that kind of core list of ticker symbols that you can trade on a regular basis. And it just takes a lot of the work out of it. It makes it really easy.
That's really cool.
Right. So, yeah, hopefully that helps. And that will lead really well into our discussion Friday, because we'll be talking about, with this market, I would not have expected it to go up. And maybe if I had sold like an iron condor in SPY instead of a call credit spread, I might still be tested on it. I might still have lost. Who knows? But, if you don't know where the market's going to go, if you don't know next week is it going to be up 5% or down, you know what I mean? Like, we just don't know. It's a really good time for neutral strategies right now, because we just don't know. I mean, I think eventually it'll drop, but we just don't know where it's going to go. And so we'll talk about this Friday, but it's a really good time just to kind of stay really neutral and kind of see what happens. And that's my strategy going forward, is just because, I'm bearish, but I mean, you can't get in front of an oncoming train and the market's going upwards and upwards and upwards. You're just going to get run over. Right. So right now, I think it's just safer to stay neutral, but we'll talk about that more Friday. So that's why I want to talk about it today, though, and that will give us a nice introduction for Friday's topic.
That's perfect.
Yeah, so hopefully that helps everyone. If you want to see the show notes, you can go to possiblepromise.com/14, and you can see the show notes there. And if you ever want to ask a question for us to cover at some point, you can go to possiblepromise.com/ask, and we will answer your question on one of our podcasts. So with that, we will see you on Friday at presumably 1 p.m. Eastern, assuming we're keeping this schedule, which this actually worked pretty well for me. So
yeah, that's awesome.
We'll see you on Friday at 1 p.m. Eastern, and see you for the next episode of the Possible Promise podcast. Have a great week, everyone. Good luck with your trading.
Bye. Everyone.
Bye.